Okay. Hello, everyone. Thank you for coming. My name is Paul Dowding. I'm co-founder, head of design for Alpha Core, and our differentiating protocol, which I'll talk a bit about, called TapestryX. I would encourage you to follow up with Eugene. He's one of the best guys I've met in the GBA. He does claim to have the best digital autonomous organization technology, but then he realized that was pronounced doubt. So that's why he changed his company to Devote. Anyway, I started my career as a manufacturing engineer. My degree is actually in aeronautics and astronautics. I ended up transitioning to banking operations because they were looking for people with production experience. And my career has been spent in operations from a management perspective, product management, and strategy and innovation. My wife said the planets aligned for me with blockchain because obviously I'm dealing with financial infrastructure. As an engineer, I'd obviously coded in hexadecimals, if you know what those are. I had to learn set theory. My father was involved with encryption in radios. So I had a series of interests, lay interests, and other experiences that when you combine all the things that are involved in blockchain, it sort of fitted. If you look at the financial services, historically, what's happened, if you look at all the markets that are in the world, that the various products have their own experts. You know, you go to an equity guy, you go to a bond guy, you've got a derivatives expert. And these are different everywhere around the world. So they tended to be siloed as far as their expertise. So when technology came along, they tended to build the technology in the silos. And you have the concept of front, middle, and back office. The front guys are the traders. The middle guys support the traders from a control and P&L perspective, and then the operations actually makes everything settle and work in the background. The problem is you've got all these different infrastructures. So while they're efficient as far as a market perspective, from an infrastructure perspective, when you go to these big banks as an institutional client, you're actually paying a toll because they have access to all these infrastructures, but it's not an efficient model. And I'll get to why DeFi is struggling a bit today. But think about it. You've got all these different these different infrastructures. And that's what we were always trying in the industry to somehow, because once you get into broader investification, what's the big thing about investments? That you diversify. Well, if you're diversifying, it means your broker is actually having to access all those different infrastructures. So how can we make them more efficient, make them more consistent? And that was our challenge. And that's what I was working on when I was talking about internalizing trades in the big banks, because we were the broker on one side and the custodian on the other. So in order to settle that trade, we could actually do it internally by what's called book entry. And think about it. If you transfer money to a member of your family or friend who's got the same bank as you, they don't send that through the clearinghouse. They just do a book entry in the bank ledgers. So this is something they can do. And while trying to do that, I was introduced to this investment manager who says, we've got these guys selling a thing called a blockchain. Can you come and advise us on whether we think it's a good investment? I'm like, okay, here's me, Mr. Operations, going into investment banking. All right. So I listened to these guys and I said, okay, so they've read The Random Walk on Wall Street, but they don't know anything about settling and clearing trades. And this blockchain thing, God, what is this? I don't know what it is. Anyway, fast forward, I'm brought into a boutique consultancy and asked, do you know anything about blockchain? I said, well, no, but I looked at it. And they said, well, can you look into it? So that became the genesis of what my for the last 9 years of my life have been. And 2015 was an auspicious year. Digital asset holdings, Ethereum, R3 Corda, obviously Bitcoin was all taking off, but there were some big enterprise blockchains. So we started looking into them. But I'm not looking at them as a technologist. I'm looking at them as from a process and control perspective. Because the thing, you want to be efficient, but the key thing with you're in charge of someone's assets, money or securities, you don't want to lose them. And how do you control it? And one of the scariest things I learned when I entered banking was there's no such thing as an incorruptible process. So basically you're telling me I'm in charge of something that I can't guarantee to secure. But that's why you have layers of controls. It's why you do two-factor approvals on your authorizations on your phones and things like that. But so we were looking at it and I read the white papers, and you can read the white papers. They all say, this is great. We're going to do peer-to-peer or B2B settlements in hours, if not minutes. and it's this revolutionary technology, but, and you see these headlines, and they say in the white papers, we can't scale. We can't handle the capacity, and we're kind of lacking functionality. And that's what I drew out. I sort of went and said, great potential, but is it a problem? And if you look at what's happening in the industry with blockchains, is that where they need scale, where they need capacity, they're trying to do all these end arounds and work it out, rather than trying to address the problem. And what we did with TapestryX was to say, how do we make it agnostic? How do we make it configurable? How do we make it highly scalable, high capacity? And also, interestingly, as a ledger, how does it have accounting? And why is accounting important? Well, any ledger that's not based on accounting, double entry accounting, is not a ledger. It's a timestamp transfer log. So when you're dealing with financial transactions, you really got to focus on that as a real output that's required. And that's one of the things that we focused on. And then we found some other unique ways to synchronize without consensus and validators, which is some of the tricks we did. But it was very interesting. So when I first joined the GBA, Gerard didn't like me very much because I kept on saying, but these things don't scale and they have capacity problems. And then what he realized was I was saying it because, and we went through a two-phase learning, I went through him sort of saying, look, I'm worried about the industry because if we're pushing these solutions and they can't meet the requirements, it's going to damage us. But there is a way to do it. So he then started referring to me as a constructive critic as opposed to just a critic. The second thing I learned is I got involved with the working groups with the blockchain maturity model. And therefore, we had to find this generic way to assess public or private blockchains, consensus algorithms, validators, all the different protocols. How could we build an assessment tool? And what I began to realize was, yeah, I'm dealing with high-frequency traders and algorithmic executions and markets that trade trillions of hundreds of millions of trades. So I'm dealing with scale that nobody else has to deal with. What I learned from the blockchain maturity model was that does your solution meet the requirements of your use case? And we just had votes talk about an election. An election has a start, a setup, a process of counting votes, and then you tie it up with a bow. It doesn't need high capacity, it doesn't need scale, and to some extent, a log, it doesn't need accounting. So now you've got the thing of where does your blockchain solution fit? So that's the important thing about the blockchain maturity model. And we ourselves went through one of the first assessments, particularly in the banking and finance world, where there's now supplements for use cases in finance, use cases in healthcare, use cases in voting. The BMM really offers, as a provider, a tool to say we can do what we say we can do, and to a buyer, some sort of security that what you're buying actually has what is required. So I'll leave you with this, which is with DeFi, if you think about it today, we have in traditional finance exchanges where you execute a trade, you send it to a custodian, and then they settle it through a central clearinghouse. A lot of the solutions in DeFi, you go to an exchange, you execute through a digital custodian, and you record it on Ethereum, which is effectively a central clearinghouse. They're actually replicating the same problem we had with traditional finance. It's just whether it's Ethereum or Solana or Cardano. And that's a real problem. And that's why they're all talking about interoperability rather than how can you get horizontal scaling? How do you truly get a solution? Now, what I'm excited about is all those different infrastructures really need a consistent ledger. Because if you have a consistent ledger, you can meet the goal of transacting, which is what the internet did to communication. Before the internet, we had to go through a central exchange and connect one-to-one. Now with decentralized internet, you just, where do I begin? Where do you begin? And let's talk. With transacting, it's going to be the real potential is, where are you? Where am I? And we just transact with each other peer-to-peer. That's the real potential. The consistent protocol, while it can be secured by hash linking, is actually double entry accounting. And that's the way to make it work. So I'll leave you at that. Thank you.